President Trump is set to name a new Federal Reserve governor this week. This comes after Fed Governor Adriana Cougler, a Biden appointee, announced she is stepping down from her role at the central bank. Cougler's term was set to expire at the end of January 2026. Joining us now is Loretta Mester, former president and CEO of the Federal Reserve Bank of Cleveland. Loretta, it is great to see you as always. Let's start there with Cougler's departure, Loretta. What do you make of it, and who do you think could replace her?
Well, I mean, it gives the president a bit sooner opportunity to appoint someone onto the board. Of course, Adriana's term was going to end in January. This, brings up a couple months early the appointment. So, I mean, the president's going to have to pick somebody that'll get confirmed by the Senate. So, there's probably a short list of people he's thinking of. But it also gives him the opportunity to appoint someone that he will appoint then as the chair or as the vice chair. So it's a real opportunity for him to put his stamp on the Fed in another seat. So I'm sure he's going to be looking at a lot of people, and we know who's been on the list of potential chairs. So maybe one of those people will be appointed, but we just don't know. I'm sure there's a lot of viable candidates that the president's looking at.
What do you make broadly, Loretta, of kind of the president's increasing political pressure on Powell?
Well, it's very unfortunate. I mean, the independence of the Fed to be able to make monetary policy, focusing in on the longer term goals of price stability and maximum employment, and insulated from short run political considerations, is really one of the tenets of effective central banking. And it's been proven in research and practice that when you have that kind of independence, or when a central bank has that kind of independence, you end up with better outcomes for the public. You get lower, more stable inflation, and you don't face a cost of more variable output or employment to get that low and stable inflation. So having the president go after the Fed chair, it won't change how the Fed goes about making its policy decisions. They're going to still focus in on evaluating incoming economic and financial information, using models, using scenario analyses to come up with a view of where the economy is going, where the risks are, and what's the best policy path to achieve the dual mandate goals of maximum employment and price stability. But it does complicate the process of monetary policy making, because the Fed now has to spend time trying to tell both the public, the legislators, and financial markets of what the fundamentals are that they look at, and what things like the president's comments they do not look at when making policy. And so it's an unfortunate situation that undermines the credibility of the Fed's process without really any gain, as far as I can tell. It doesn't change what the Fed's going to do or the way it goes about doing it. I think it's sort of detrimental to one of the goals that the president says he wants, which is lower long-term interest rates. In fact, if the Fed were to lower interest rates, short-term interest rates, its policy rate, disregarding what is appropriate just because the president wants the Fed to do so, I think long rates would go up, not come down. So that undermines that goal. And it also makes it much more complicated for whoever the new chair is going to be, because that person is going to have to really build credibility with the public, with Congress, and with the other members of the FOMC who vote on monetary policy. So again, I don't see any gain from this, and I only see costs.
I have seen Mohamed El-Erian, Loretta, give interviews to the press, and he's telling reporters he thinks Powell should step down. And his argument seems to be, Loretta, well, if Powell stepped down, that would actually sort of diffuse the situation you're describing there. It would minimize the attacks, and in so doing, it would actually help preserve the Fed's integrity and independence. What do you make of that argument?
I couldn't disagree more with that. Firstly, anybody who thinks they can kind of game the administration and the president on any of this, I think is incorrect. I mean, I don't think you can sort of think down the tree that way. I think the best way to preserve independence is for Jay Powell and the Fed to be doing exactly what they're doing, which is focusing on their mission, the dual mandate goals, doing the hard analysis, bringing as much data, analytics, scenario analyses, forecasting, to really evaluate where the economy is, to evaluate and balance the risk, and to then set monetary policy to achieve those dual mandate goals, and really focusing in on doing what it always does, which is really care about the long-term goals that Congress has given to it and ignoring other things that could be a distraction from those goals. And I don't see any reason that Jay stepping down, Chair Powell stepping down, would further the mission of the Fed in any way.
There is a question being asked, Loretta, in certain political circles, so I want to get your take on it. I'm sure you've heard this question. The question sort of is framed like this. Why did the Fed cut late last year, an election year, but won't cut now, even as inflation has calmed down? What do you say to that?
Well, it's doing the same kind of analyses, right? Back in September, it had gotten some reports on the labor market that ended up being looking weak. And so it ended up starting, and inflation was actually still above goal, but it had been moving down. And the forecast was that it would continue to move down, and there was more evidence that the downside risk to employment had risen. And so it did the evaluation, balancing the risk, and thought at that time, okay, it's time to start reducing the level of accommodation. Because remember, at that time, right, the monetary policy rate was high. So it started that process. And in fact, it even cut 50 basis point rather than just the 25, which is more typical, because it was concerned about um, employment. Of course, some of that weakness in the employment data got revised away later on, but nonetheless, right, the Fed was on that path. When this year came, it looked like inflation progress had stalled at the beginning of the year. And then when the tariff announcements came out, those tariff rates were quite high, with the potential of really raising inflation, perhaps in a one of way in terms of prices moving up, inflation moving up, and then inflation falling as the new price level, higher prices were achieved. But nonetheless, potential for inflation to move up and maybe persistently up. And so it had to balance that risk against a labor market that looked like it was in balance and we had achieved, or the Fed had achieved, maximum employment. Now it's going to do the same kind of analysis. It's going to look at the recent data, which showed that the labor market momentum has really stalled and that, labor demand has been weaker than expected. The bottom isn't falling out of the labor market because supply has also moved down, but nonetheless, the downside risks to the labor market have again moved up. But there's also evidence that we're now starting to see prices move up for particularly the goods on which there's tariffs. That could be a one-of movement in prices up for goods that are tariffed, but it also has a potential of leading to broader based inflation. They're going to have to continue to evaluate. There's a lot of data coming in before the September meeting. I think they'll walk into that meeting with an open mind. They'll do the evaluation that they do, and then they'll decide what's the best path for policy to balance those risks, which have shifted since the summer.
Would you, Loretta, and granted your point is well taken, a lot of data between now and then, but in September, would your bet be that we see a cut?
Well, it really does depend on how things come in. I mean, the way I view it is, look, we know the downside risks to employment and labor have moved up, right? So employment is considerably weaker than we thought. But we also think that inflation, right, we're starting to see those prices move up. But if we continue to see the service side of prices continue either staying where they are or moving down, I think you can make a case for a 25 basis point cut. But I also think, right, there are going to be people on both sides of the issue. Some are going to say, we've already have a level of the funds rate, which is not that restrictive. And so since inflation is still elevated and moving up, we should hold pat. And others will probably balance the labor market risk as being the more significant one at this point, especially for those who think that policy is restrictive and perhaps more than modestly restrictive. There's some who think it's moderately restrictive. They could cut 25 basis point and still have a restrictive policy rate that'll work on inflation. So I think there'll be people on both sides of that. But again, we can't say today because we don't know what the data is going to be. We're going to have to see the labor market data and the inflation data to get a better view of what that progress going forward looks like on those mandated goals.
Loretta, always great to see you. Thanks for joining us.
Thanks very much. Take care.